Richard, do you want to take over the presentations?
Thank you, James. Always interesting. Right, here we go. Okay, so we have Laura Elkin on today from AEW UK REIT. Are you there, Laura?
Yes, I'm here. Hi, Richard.
Hi. How are you?
Very well, thank you. How are you doing?
Good. Yeah, good. So, yeah, really interested to hear from you today and get your views on the sector at this sort of particularly difficult period, I suppose.
Yes.
So that's a brief sort of bio of you. We're going to your slides. I don't know if you just want to spend sort of 5 minutes just introducing the fund basically, and then we'll get on to some questions.
Yeah, great. Thank you. Thanks very much. And good morning, everyone. As Richard said, I'm Laura Elkin. And before we start, I'd just like to give a quick introduction to AEW's business. So AEW is a real estate specialist manager. This is the only asset class that we invest in, and we are one of the world's largest real estate managers. We have 70 staff in London, and from here we run a number of strategies, one of which is the AEW UK REIT PLC, for which I am the portfolio manager, and this REIT is, of course, the subject of our discussion today. So moving on to the next slide, please, Richard. What is AEW UK REIT, or AEWU as it is often referred to? The REIT was IPO'd by the team at AEW, with myself included, 7 years ago. The company's strategy is to very actively manage the direct real estate assets that it owns to drive high income streams as well as capital growth. This has been demonstrated in the delivery of our dividend, which has been paid at 2p per share per quarter now for the past 26 consecutive quarters since the completion of our initial ramp up. It's also been demonstrated in the very strong NAV growth that we've seen, and I've got further slides on this coming up. We achieved these results using value investment fundamentals, stock selection, and a very proactive approach to asset management. We very carefully select the assets that we're buying, and we are looking for those that are located in strong commercial locations that also show low levels of supply for competing space. We often access high day one yields by buying these assets with shorter lease lengths, and this is because we see lease events, particularly expiries, as an opportunity rather than a risk. So if we have chosen the right asset in the right location, then lease expiries provide opportunities to increase rentals in a more meaningful way than through the rent review system. The company also accesses a yield advantage by acquiring assets with lot sizes between 5 and 15 million. In this size bracket, we meet less competition from other purchasers, as it tends to be too large for private investors and too small for a lot of institutional asset owners. But despite the value growth that the company's already achieved, the portfolio today still represents a value proposition with a low capital value across all assets of just over £70 per square foot and average passing rent of £5 per square foot. So very low levels when compared to the real estate market as a whole. Our range of purchase yields is generally between 7 and 10%. Moving on to the next slide, please. This slide shows some high-level statistics for the portfolio. The portfolio comprises 36 properties and has 130 tenants. If you refer to the pie charts on the right-hand side of the page, you'll see our spread of property sector exposures and also geographical locations. These are diversified by design, and we use the granularity of the portfolio as and its diversification as a risk management tool. We use debt within the company, but at a very modest level of 30%. We have one facility currently, which we refinanced last month to move from a floating rate to a fixed interest rate in light of the rising debt costs. So we're now really pleased to have locked in our cost of debt for the next 5 years at a low fixed rate of just under 3%. Just on this slide, the portfolio's yield profile is, I think, worth touching on briefly here for two reasons. Firstly, that the portfolio's initial yield is currently suppressed somewhat by an asset in Glasgow, which we have driven to vacancy in order to make a sale to a developer of student housing. This process, albeit the right course of action in order to maximise the value of that asset, has been rather costly to the company's dividend cover on the way through, but I am incredibly pleased that the completion date for the asset sale has now been fixed at late August this year. So we are very excited to be able to shortly have that capital reinvested into a new property that will be income producing and therefore much more beneficial to the dividend. Secondly, just on the yield profile here, and particularly in respect of the reversionary yield, that even accounting for that Glasgow property I've just mentioned, the portfolio is significantly reversionary as independently assessed by our fund value and Knight Frank. Therefore, over the medium term, our income levels are expected to grow. This next slide, please, shows the high yielding nature of the company compared to its peers in the UK diversified REIT space. AEW is one of the highest yielding and was the only company in this set not to cut or suspend its dividend during the pandemic. And this is a matter for which we are very proud. Another strong achievement is that the company's dividend has been 98% covered by EPRA earnings over its entire payment history, and with that remaining 2% having been more than made up from cash profits from the accretive sales of our assets. Turning to the next slide, this is the REIT's property level performance, where the assets have together outperformed the MSCI All Property Index over 12 months, 3 years and 5 years, and it is for this reason that AEW has been awarded by Citywire its Best Generalist Property Company Award for the past 2 years. Our cumulative outperformance of the index has been close to 17% over a 5-year period. Continuing on to the next slide. So what specifically has been driving the company's performance? Of course, the portfolio's high level of income is a very good place to start in order to achieve high returns. In addition, though, the sale of profitable sale of assets where business plans have been realised has significantly boosted our performance. So since IPO, the company has completed on the sale of 8 assets, and the profit generated from the 4 most recent of these is shown on this slide. A running theme throughout all of these 4 assets is that effectively no or very minimal capital was invested into the buildings by us during our hold period. So it isn't in these cases that valuation gains are down to betterment of the asset. What these gains can be attributed to is active management of the assets. And I'll go into detail on a couple of these, but conscious of our time constraints, I'll perhaps pick out 2 and focusing on the least obvious of the 2, i.e. those not within the industrial sector. So starting with Corby on the left-hand side, this asset was acquired in early 2018. It was an asset that we identified as being mispriced due to its land value. Essentially, it was just a very large car park yielding 10%, but the location was adjoining both residential and logistics development, so significantly higher value uses. We held the site for just over 2 years before receiving an off-market approach to sell to an adjoining owner for just under 19 million. That is a 52% premium to the asset's acquisition price. On the right-hand side of this page, an office in Solihull. This one we acquired with a 6-year lease to the government, noting that they were very wedded to the building due to their specialist fit-out that accompanied the building's use as an immigration processing centre. Upon expiry of that lease, we renewed to the government for a 15-year term with a 30% increase in the level of rent payable. The government also committed to undertake a full refurbishment of the building, so we did not have to invest in any betterment of the building or capital expenditure here at all in order to facilitate that lease. That lease then, of course, created an investment that was much lower yielding than would have been accretive to the company's dividend. So the building was then almost immediately sold for a price 94% in excess of its purchase level.
Wow. Cool. Okay, well, yeah, that's a great intro on what you guys do and how you create value. I've got a couple of questions. I don't know. Are you finished there with a couple more sort of case studies that you wanted to go?
I've got a few more case studies, but we can save those for later on if you want to do a few questions now. That's fine by me.
Yeah. Okay. Yeah. I'll start off with a couple then. You mentioned about your dividend there, and obviously being one of the only in that peer group to not cut it during the pandemic. But you also mentioned there that the covered not being covered by earnings for the last. How long has it not been covered by earnings?
It's about 18 months. Over the past 12 months to March, our dividend cover was about 85%. Right,
and that's because of the Glasgow property that you mentioned, was it?
So I would say over that time period of being uncovered, Glasgow has been a very significant reason, yes. We have also had some quite significant capex on an asset in Blackpool. And both of those, I think we've been quite open with investors about sort of explaining that process that we're going through there. But that Blackpool capex is coming to an end towards the end of this summer, as is in a similar time frame, the Glasgow asset now committed to be sold. So once that capital from the Glasgow sale is reinvested and we are back to full investment, then we definitely look to be back on track for our dividend cover.
Yeah, is it any sort of time frame on that, you think?
So the sale is completing at the end of August, and that's also the time frame for the finishing of the capex. Now, of course, we are aiming to have that capital reinvested as quickly as possible. And I think all I can say at the moment is that we are pursuing, very actively pursuing at the moment, an attractive pipeline of assets that I think look very similar to the attributes shown within the current portfolio. So we actually made an acquisition last week, I think, to demonstrate that high yielding, low rent, and with some further prospects for growth. So the pipeline looks strong and we're looking to get that capital and reinvested as quickly as we possibly can.
Cool. Okay, yeah, there's a question coming on the Glasgow property, so sort of last mention of it, I suppose. How long did it take you to get that vacant and that whole process?
Gosh, yeah, so it's been it has been quite a while. So I think it was probably about 2 years now in total that we've been working on this. Yeah, it's about 2 years ago that we first started to engage with it. It's IQ Student Housing who is the counterparty here. And yeah, about 2 years ago that we first exchanged contracts with them. And of course, a lot of that process has been them getting their planning consent. So it's not that it's taken us that long to get the building vacant. It's more that that's how long their planning process has taken.
Right. Okay. And then the other thing I wanted to touch on, there's been a lot of written about EPC ratings and the new legislation that might come out in the next sort of year or so about EPC targets on commercial buildings. What is your portfolio looking like EPC wise on the ratings, and do you envisage much capex to bring that up to the required standard?
Yeah, that's a really important question. It's incredibly topical at the moment, and something that we're working on at the moment. So first of all, I think perhaps by sort of dispelling a myth or two, I think it's often believed that with secondary assets, the EPCs are necessarily lower. But of course, the EPC is reflective of sort of the efficiency of energy use within a building. So a building with a higher energy use would, if that's not being sort of dealt with efficiently, could have a low EPC, whereas buildings with less specification in, shall we say, can have lower EPC. So I think, for example, taking our portfolio, we've got 50% exposure to industrials, and industrials in our case are sort of good secondary assets, but they tend to be pretty low specified. So actually, it can be fairly easy to make some easy wins on EPCs with our assets, because of the fact that, you know, they're not very complicated sort of central London office buildings. So I think just to dispel that for a start, we've recently analysed where our EPCs sit, and that's a process that we're sort of got ongoing at the moment. But we don't have a significant amount that we're concerned about. Of course, we need to factor in those costs over coming periods. And we're looking to do that, but we don't believe it will have a material sort of negative impact on our performance for a number of reasons. Firstly, that in multi-let assets, we can often put some of that spend if there's capital that's needed through service charges. And secondly, when single-let buildings reach lease expiry and we receive dilapidations payments back from tenants, then we can reinvest that money back into the improvement of that building from an EPC perspective. So yes, I think there's a lot of work to do in terms of us just working out exactly where that capital needs to be allocated to. But in the course of the usual running of our business, I'm not expecting that it's going to be hugely materially negative.
Okay, and we've got a question here on it as well. What is the average EPC rating across the portfolio? Do you have that data on how many sort of A, B, C, D?
Do you know what? I think we've got a fairly sort of normal distribution across those. I'd say we've got sort of more B's and C's than we do A's, but equally, I think we've got more B's and C's than we do E's. So do you know, I don't have that average rating off the top of my head, but I think what I can say is that we don't have a significant amount of concern coming up.
Okay. There's a couple of questions here on. I think you mentioned that you don't really put that much capex into the buildings during your whole period, and the asset management is all from sort of releasing and things like that. So we've got, is it a philosophy of the trust to not undertake asset management to the properties, or is that one of the sort of investment criteria when you're buying properties?
So maybe if I could just, I don't know, rephrase that question slightly. Of course, it is deeply fundamental to this strategy that we very actively undertake asset management. And asset management I describe as, you know, really any sort of change to a lease or change to a building, or it's not that asset management has to be development or has to be putting a spade in the ground. And I think it's probably more just those 4 particular examples that came up were buildings that showed a significant amount of profit, but happened to be examples where we had not invested capex. Of course, when we're looking to pay out a high level of income, which we are here, minimising capital expenditure goes hand in hand with that. But I would absolutely say that where capital expenditure is needed in our buildings, then we assess that from the very start before we buy an asset, and then where it is needed, we will spend that. Because of course, you know, we can't have our buildings falling into disrepair. That would be absolutely not positive for the strategy at all. And I think a good example of that is of course the building in Blackpool, which I've touched on and which we've talked about in various public announcements. That building required some capex, and we have spent it. And part of that was rechargeable through the service charges, but part of it wasn't, and it fell to us as landlord. So that has been dealt with. I think if I can perhaps refer back to one of the slides here, Richard, slide number 8, where we've got a building in Bristol. Further down the pack, just the next one, I think. Yeah, this one. And I think this is a really good example. So this is an office building that we've owned since late 2015. At the time that we bought the building, it was quite unloved. It was 50% vacant, but within 18 months, we had all of these office suites let and were starting to increase rental levels. And sorry, the reason why I thought this was sensible to talk about now was the fact that we have numerous times in reletting these office suites, which we have sort of continued to churn through to keep increasing rental levels, is had a rolling refurbishment program. So we've been spending capital here because it has been needed. But most of that capital has been either paid through by tenant dilapidations, outgoing tenant dilapidations, or been rechargeable through the building service charge. So that for us is really the sweet spot in terms of the type of building to invest capital into, where we can look to put that cost back on our tenants as well. And here that has rewarded us with a continuously increasing level of rental value. And in fact, we have another of the suites currently under offer, with some light capex going through at the moment just to improve that suite, but proving a new high rental tone for the building. So actually a number of times we've considered selling this building because we wondered if its value may have peaked. But each time we look again at the tenant supply demand dynamics for the location, we keep hold of the building and then are rewarded by stronger growth.
Interesting. Cool. All right, sticking on offices then, we have a question on the office sector. Obviously, it's been talked about a lot during COVID and the future of it and how people use it going forward. First of all, how much of your office portfolio is in prime locations and secondary? And then what are your thoughts regarding the outlook on the offices?
Yeah, thanks. So we currently have about an 18% exposure of the total portfolio to offices. How many of those are prime? Of course, we are selling the office asset in Glasgow, which makes up part of that 18% for alternative use development. We then have the office building in Bristol, which I've just talked about, an office building in Oxford, which we can perhaps come on to talk about afterwards, because that has also been the subject of a recent announcement. We then have two smaller office buildings, one in Gloucester, which we own due to its significant sort of underpinning through residential values, and a further one in Hemel Hempstead, which is also underpinned by industrial values. You know, those last two offices there, I perhaps consider those to be non-prime locations in the strictest sense, but due to their alternative use underwrite, they perform perfectly well for what they're doing. And then we have that underwriting in case they didn't. In terms of the office market as a whole, though, you're absolutely right that it's been the subject of much debate over the course of the last 2 years. And my beliefs are that I think hybrid working brings some positives. I think hybrid working will be here to stay to a certain extent. But one thing that I absolutely noticed when we came back to the office after the pandemic was, yes, do you know what, we did operate well from home. We operated perfectly well from home. But when we came back to the office, we were much, much more creative, much more collaborative. I think we thrive on being together as a team. I think we just we generate much more business and much more ideas, and we much more productive when we are sat in the same building together. So I personally think for our business that our office brings us a lot of positives, and I can't help but think that other companies must be thinking the same thing, and where I've discussed this with other people, they have often agreed with me on this. So I absolutely don't think that the office is now defunct. In fact, where we are looking at our investment pipeline at the moment, we're being pretty cautious about this, but I'm having a look at a few office buildings in our pipeline. Just to think about perhaps in some certain locations has the property market viewed them too negatively, and are their values now looking like a good value proposition in some sort of strong regional markets? So yeah, that's my views on the office market.
That's interesting. Yeah. What we wanted to question here on the sort of impending recession, we'll hope not, but what are you worried about that, and what that impact that will have on vacancies?
Yeah, so of course, I don't think it's good news for anyone if we enter a recession, and I very much have my fingers crossed for all of our sakes. But looking at the strategy here, I think we use a number of different tools to help protect investors' downside position. So I talked before about us buying and holding these assets at low capital values, and us finding low rented buildings particularly interesting. And that comes back to our value investment philosophy, where we're buying assets at values that are more akin to their long-term fundamentals. And we think that means less value erosion in volatile markets. So the value that we're buying and holding these assets is supported by the vacant values, perhaps the land values, the value of the underlying bricks and mortar, which has of course increased a lot recently with inflation seen in that area. So I think that provides a lot of downside protection. And when we buy assets, we always ask ourselves the question, what would this asset be worth vacant? And that might sound like a very negative thing to ask yourself, but actually it's very, very important to us on purchase, because if that is too far different from the purchase price, then we are likely to think very long and hard about whether we buy that asset. So and I think that goes hand in hand with our approach to buying shorter leases as well. If you think about us buying a slightly shorter lease profile of buildings, then we are buying those assets at perhaps one of the lowest value points in their life cycle. So we're exposing ourselves to less erosion through that. Another aspect that we look for on purchase and that we think about very carefully is alternative use optionality for our buildings. So with those last two office buildings that I listed when I talked about our office portfolio in Hemel Hempstead and in Gloucester, those, as I said, I think you'd probably class as non-prime office locations, but we have been happy to buy them in those locations because their value is underwritten by alternative uses, much higher alternative uses, and again that provides some downside risk there as well. So I think there are various sort of fundamentals that are built into the strategy that protect that position for investors.
Cool. So obviously you've got a large weighting to the industrial sector. Do you think that's going to be sensitive to a recession? What are your sort of thoughts on that?
So I think the industrial market has evolved hugely over recent years. And I think now when we say the word industrials or warehouses, everyone's mind immediately springs to sort of multi-story, very shiny automated Amazon units. But actually, if you were to go and look at our industrial portfolio, you would find that they would look incredibly different to that. And ours are just good secondary, well-located steel frames. And the average passing rent across our industrials is only about £3.50 per square foot. So incredibly low in terms of the levels where that market has reached in in a lot of locations now, to be honest. So we still have I think a very conservative approach there. So starting from that low base, there is still a good backdrop for rental growth, and occupier demand in the industrial markets is still strong. How that looks for the remainder of the year is to be seen, but I think starting from the base of that value perspective with the low passing rents that we have, A lot of those are underwritten by their land values or underwritten almost completely by their build values. I think our average capital rate per square foot on our industrial buildings is around £50 per square foot, and you simply can't build those buildings for those kind of levels now. And of course, within that value, we have the land as well.
Yeah, that's interesting. So are a lot of your industrial tenants, are they SMEs in the main?
Do you know what, they really range in size. So I think another point here is that people believe that in smaller buildings you get a lot of smaller tenants, and actually that's not always the case. You know, we have some well-known tenant names, some very significant global businesses in some of our industrial units, but also of course we have some smaller properties and companies too.
A question just come in on what sort of due diligence do you undertake on tenants before they come in, and sort of their ability to pay the rent? How is that assessed?
Yeah, we do quite a lot of due diligence here, but I would say that the level of due diligence can differ. So you know, if we're buying a single let building where we think there's a significant amount of value held in that lease, then we will of course do our homework there and make sure that we have done a lot of due diligence on that tenant. But if it is a multi-let asset that's almost completely underpinned by its land value, then yes, we want to know that the tenants can pay their rent, because that is of course where our dividend comes from and our income stream. But it will be, I guess, less important to us over the long term as well. We use a company called Coface, who are a credit insurer, to undertake a lot of tenant due diligence for us. And for example, they have, you know, where it's in that first scenario that I described, where a lot of value is held in the lease, we have in the past, you know, joined conference calls with financial directors of our tenant companies before buying them, and we will be provided with detailed reports on the company's accounts that we take to our investment committee before signing off on those purchases.
Cool. I think last one on the portfolio specific. You've recently bought a Prism nightclub in Cardiff. What was the sort of thinking behind that purchase?
Yeah, so asset was a high yielding asset. So the income stream from that would have been accretive to the dividend. That would have been one of the first points. As a second point, we would have looked closely at the trading information, and we find it quite interesting sometimes where the tenant business is this kind of sort of trading business where you know, if you can look at the accounts for that business itself, and I don't mean the tenant accounts, but you can see, you know, how much cash that site is generating just from its own trade. And therefore how much rent can be afforded. We often find that quite an interesting way to judge just how important that building is to that tenant's portfolio. And this one we realised was an incredibly strong trader, generating a profit from its own operation that would have more than supported the level of rent that was being paid. So that is also a very attractive feature. And then just coming back to the location, obviously city centre, located in an area with a lot of footfall, strong fundamentals from the nearby university, and the other things that city centre has to offer. So yeah, all in all, quite an attractive asset for us.
Cool. Right, but on to sort of income then, and how much of your the rent is inflation protected?
So we do have one or two leases in the portfolio that have reviews that are linked to RPI, directly linked to RPI or CPI and their growth. But they are really very few and far between. I think in across the whole portfolio of 130 leases, we have less than 10. we of course realise that where we're renewing leases, where we can put those leases in place with inflation linked, then because they have been sort of viewed as quite in favour by the rest of the investment market, then of course that's going to add a lot of value. So where we can look to put them in place on renewal, then we will absolutely do that. But you won't see us buying a lot of those leases for a number of reasons. Firstly, that they tend to trade at keener levels than we would want to pay. I think coming back to the point about buying properties in line with their fundamental values and our sort of value investment philosophy, I think that the sort of long inflation linked lease theme goes against that somewhat because it tends to then increase the value of the building, and then of course you are paying a significantly higher value than your asset fundamentals, and you have more significant room for capital erosion if there were a downturn, and that is the way that we see things. But that's not to say that we don't think that our portfolio provides some protection here. So I think coming back to our portfolio's yield profile, the reversionary yield being some 20% ahead of our initial yield currently. And remember, that's independently assessed by our fund value in Knight Frank. So that's not just a number that we have calculated ourselves. That 20% sort of inherent ability for the portfolio to grow value is built into those assets that we already own. So we think that is our answer to sort of inflationary growth at the moment. And I would maybe just mention sort of one example. We had a rent review, open market rent review on an industrial building up in Bradford. And over a 3-year period, we secured a 14% increase in the income there. So about where inflation linked leases would often sit, they often have caps in them, only up to 3 or 4% per annum. We, I think, in quite a few cases now on our industrial portfolio are achieving rental increases either at renewal or at rent review that exceed those levels of inflation. And I think it's becoming a trend now in the industrial market for leases to prefer to be open market reviews than have RPI or CPI.
So what proportion of your rents are coming up for renewal renegotiations over the next sort of couple of years or so?
I think maybe the best way to describe that is that our average weighted unexpired lease term to expiry is just under 6 years. So within 6 years, you would see us go through a full cycle with all of our leases on average. Okay,
but you don't have the number of coming up in, say, the next year or so to sort of capture that rental growth?
Do you know what? I don't have that off the top of my head, but I think perhaps the way to look at our income improvement over the next year is going to be much more materially impacted by the reinvestment of the sale proceeds from Glasgow, which is currently not income producing at all.
Yeah. Okay. Cool. Right. What should we go to next? Back to the dividend, is there a prospect for dividend growth?
So this is a question that we get asked a lot. I think we are, given where we're sat today, I think we're more focused on maintaining the current dividend and also providing total return to our investors. As a REIT, of course, we are required to pay out 90% of our property income as dividend. So if we get to that level, then of course it will be distributed. But at the moment, we don't have a policy for that. And as I said, I'm more focused on maintaining the current dividend and providing a strong level of total return.
Okay. And you spoke about your sort of investment pipeline. Is there plans to grow the fund, or is that all going to be sort of from recycling capital?
So we've got quite a significant amount of capital to recycle from Glasgow. That will be just over £9 million that we receive back. And also we haven't actually discussed this yet, but we have a significant other sale under offer at the moment of an asset in Oxford, which is something that has also been announced to the market. So over the course of the late summer, we will have in excess of about 45 million to reinvest. So yes, a significant amount to work through in terms of recycling that capital, but we're also tracking an excellent pipeline at the moment, and we have some assets under offer. So yeah, I'm feeling pretty positive about reinvesting that capital as quickly as we can. We have a much wider pipeline than that. As I say, we're looking to recycle about 45 million. I think the pipeline that we're tracking at the moment exceeds about 100 million. And we're finding at the moment that we are seeing quite a high number of really attractive assets across a range of different market sectors. So we'd love to be able to grow the company in order to take advantage of that, but of course, the share price has to be supportive of us doing that. And we had a period where we were trading at a premium earlier in the year for quite a number of weeks and months, but that's no longer the case with the volatility that we're seeing this week. So I would like to think that once that premium returns, then we can have a think about doing that then, just to take advantage of those attractive assets.
Yeah, interesting. One on your sort of on the debt, but just quickly one to come in. How long do you typically own your assets?
That's a really interesting question. Do you know, I wouldn't say that there's really any sort of theme there at all. As I said, we've got a portfolio of 36 assets. In the course of the 7 years, we have sold 8 whole assets, but of course we've got 2 more that I've just discussed coming up pretty quickly now. I think you know, in the first few years we were sort of less likely to be selling assets because we had of course, being a sort of fairly new company in the early years, just sort of commencing business plans. And now I think there's a good number of business plans in the portfolio that have been maturing, which is why we have been selling assets. So I'd expect to see that number, if you look at the average over the 7 years, be higher over the sort of coming few years now. Yeah, I don't think I can really sort of guide on how often we generally look to hold assets for, because you know, it's really dependent on their performance, and we analyse each asset for either a hold or sale every quarter with our valuation. So each asset is assessed very regularly. Yeah.
Okay, and then on the debt side, you mentioned it earlier. So LTV is around, is it 31% at the moment?
30%, yes. 31, yeah.
And then do you have much exposure to the rise in interest rates? I think you said it's 5-year fixed, isn't it?
Yeah, it is. And prior to this, for the previous, I think it's about 6 years, we had a facility with a floating rate. And that served us, I think, very well during that period. Had a very low cost of capital. But now, of course, in this rising cost of debt market, we took the decision about 3 to 4 months ago, even though our previous facility didn't expire for another year, to just start exploring that and trying to lock in the lowest possible cost that we could. So I think, sort of sat here today facing the market that we are, knowing that we have already locked in that fixed cost for the next 5 years at just under 3%. I'm feeling incredibly pleased about that. I think it was a very prudent decision that we took. Yeah,
cool. And then last question on Alex Short, the fund manager who left fairly recently. So question here, what comfort is there for investors knowing that there's resources behind you, and what controls do the board have to protect you from leaving?
Yeah, so I guess touching on Alex, of course, she left the business, AEW UK, as investment manager probably about 6 weeks ago now. She handed in her notice and has been on gardening leave since then. I think hopefully it would provide a significant amount of comfort to investors that my involvement involvement in the company has been since IPO. I've also been joint portfolio manager alongside Alex since early 2020. I think I'd also touch on our team here and say that we don't run a star culture. You know, we don't attribute all of our, if we have great performance, we don't attribute all of that to one person. You know, I think every single member of our team here is incredibly important. And within our business, there's about 25 different people involved in the running of this company. So, you know, all of our excellent performance is down to each and every one of them. I'm just sort of leading that currently, of which I'm very pleased to be doing. We've got a very young, very motivated, very creative team in-house, and I think that provides a lot of comfort and reassurance to the board. We have a very close working relationship with them. And with our asset management, as I've said a number of times now, being very key to this strategy, we have a very well-resourced asset management team.
Yeah, cool. Okay, all right. Well, thanks a lot for joining us today. That was really interesting. And,
no, thank you very much for having me.
Yeah, all the best for the future.
Thank you.
Thanks, Noel. So a couple of minutes over. Sorry about that, but here's the list of guests we've got coming up over the next few weeks. A couple of spaces there. So again, if you've got anyone you wanted to hear from, let us know and we'll invite them onto the show. And I think we'll leave it there. Thanks for joining us.